So, you want to invest into the stock market. I'm pretty sure many people have told you that you should turn back because you will lose a lot of money. But let us be honest. Do you lose more money eating out or cooking at home? Do you lose more money renting or buying a home? How much you lose is completely based on you. Many choose to jump into what they do not understand. We don't want you to go down the rabbit hole of putting money into a brokerage account and just trading. We want you to build wealth. Investing into the stock market is not for the weak. However, by choosing to do your research and follow these steps, your journey will be easier. 5, 4, 3, 2, 1. Let's invest. Step 1. Do research. What is a stock? What are the types of stocks? What is the stock market? When does it operate? What are the different types of traders? Any questions or concerns you have, research it. You should learn the basics about stocks before investing into it. On paper, trading stocks is simple. Buy a stock, stare at the stock until it goes up, then hit the sell button. But that's on paper. To do anything, you must first understand that research is a no-brainer. However, many people avoid doing it. Yet, for those who do the research, trading stocks will be the least of their worries. Step 2. Determine your approach. There are 2 ways to approach the stock market, as a trader or an investor. Both look to make a profit from buying and selling stocks. There are differences. Traders have quick turnaround. They intend to make a quick profit and only focus on a short period of time, buying and selling within days, weeks, even hours. They focus on the direction of the move to catch a profit, rather the long term, like investors, who are in the markets for the long haul. Their profits are built over time, resulting to them holding a stock for months, years, even decades. What about losses? Both will lose money. There is not a one-fits-all. The important factor is not to avoid losing money, but cut losses. Most traders use a stop loss or manually close out a losing trade at a predetermined price level to cut losses and protect capital. Investors tend to do things differently, riding out the drawdown with the expectation that the stock will rebound. Both make profits from the markets, just the methods are different. One is long-term and one is short-term. You must choose the approach that works best for you. Step 3. Determine how much you want to invest. Before we can talk about investing money, let's discuss the money you shouldn't invest in hopes of making a big return. The money you need to pay bills, your emergency fund, and your child's tuition fund. The list could go on for ages. There is too much uncertainty. It's not unusual for the market to drop 20% in a given year. In fact, during the 2020 pandemic, the markets dropped 40%. Yes, it did rebound in a few months. However, the aftermath of the pandemic still has our economy in shambles. Step 4. Open a brokerage account. The easiest way to open an account is through an online stockbroker. As a beginner, the best account to start with is not a live, but a demo account. That way you can develop an investment strategy. Opening your brokerage account is usually a fast and painless process that takes only a couple of minutes. There are many ways to fund it, such as mailing a check or wiring. The process does consist of filling out an application and verifying your identity. The process is pretty straightforward. However, there are a few things to determine which one you need. For most people, that means choosing between a standard brokerage account and an individual retirement account. Both are pretty much the same. Factoring why you're investing and how accessible you want your money is the underlying difference. Do you want easy access to your money? Are you just investing for a rainy day? Then a standard brokerage account may be the best option. On the other hand, are you preparing for retirement? An individual retirement account may be best for you. The only downside is the rules and regulations, which can make it really hard to get money out in times of need. Also, make sure to compare cost and features. As you do more research, you will know exactly what you need. Step 5. Choose your stocks. There are many factors to consider when selecting and studying a stock. Here are a few important ones. Diversify your portfolio. Invest only in businesses you understand. Avoid high volatility stocks until you get the hang of investing. Always avoid penny stocks. Learn the basic metrics and concepts for evaluating stocks. Diversifying your portfolio is a good thing. However, too much diversification can overwhelm you and your portfolio. So edge on the side of caution with it. There is nothing bad about having one industry make up a lump sum of your portfolio. Buying the stock that is trending with everyone can have high growth benefits. However, the wisest thing to do would be run your own race. Gain more experience. Step 6. Set an investing budget. A little amount consistently going into your account will provide more long-term gains and help you yield amazing results. You don't need thousands going in to make good profit. Just a budget from your income that is allocated towards making you money, whether that is monthly or weekly. Step 7. Evaluate your performance. Monitor your performance and compare it to your past track record. It's a great idea to track your trading. You may need to rethink your trading strategy if you're consistently underperforming. Step 8. Be mindful of your tax liability. Trading stocks can create some troublesome tax problems. The IRS do want their cut. There isn't any reason to play games with them, especially since you are focused on making money. So, the profits from trades are considered short-term capital gains and get taxed as ordinary income, up to 37%. When you sell an asset that you've held for over a year, you face the more favorable long-term capital gains rate, which top out at 20% for the highest earners. Book an appointment with your local licensed tax advocate to get specific information for filing taxes as a trader. Remember, always do your research. Trading stocks is a learning process. Do not rush it. Take your time. Your money will come. It's better to be a great trader who took the time to learn the skill than be a used-to-be trader saying the stock market is a bad idea due to being impatient or greedy. Keep growing, because if not you, then who?